The AI hyperscalers have unveiled billions of spending this year, with some companies doubling the amount they plan to spend on development compared to last year. Well, that news hasn't been taken all that well by the equity market this round. How's the bond market viewing all this? Joining us now to discuss is Rachna Bhatt, VP and Director of Investment Grade Credit Portfolio Management with TD Asset Management. Rachna, always great to have you here with us.
Likewise, great to be here, and happy Friday.
Happy Friday indeed. AI keeps being the big story. The hyperscalers had been promising heading to this year big spending. We just came out of an earnings period. What did they actually tell us about their spending plans?
Yeah, Greg, so what we've learned is the spending is not slowing, it's accelerating. So when you look at the big hyperscalers, which is Amazon, Alphabet, i.e. Google, there's Microsoft, Meta, and Oracle, they are spending, or they came into the year expecting that they'll spend more than $500 billion combined. But that number was revised to more than $650 billion. So that's up about 65%, since last year's spending. Now, most of that upside surprise in CapEx has actually come from Amazon and Google. So thankfully, companies that have very, very solid balance sheets. Now, that's for the year. Now, when you think about call it the next 5 years, the spending expectation is for $5 trillion. So let's say on an average, $1 trillion combined for those 5 hyperscalers. Let me contextualize this for you. If you take S&P 500 in 2024, added all the CapEx for the companies back then, the number would have been $950 billion. So less than what these 5 companies are spending just by themselves on an average over the next 5 years. So yes, this is very large, concentrated investment cycle, and that's what makes it very important as well. These companies are spending to build out, the technical infrastructure to support AI and cloud demand. So a lot of these companies, you'll see, will shift to negative and net free cash flow, which is free cash flow minus CapEx minus shareholder returns. What happens when your free cash flow is negative? Well, you need to borrow more money. So they'll be issuing a lot more debt, as they fund this build out over the coming years.
Now, last year, maybe some exceptions, but every time one of the big hyperscalers came in and said, man, we're going to spend so much money, the market said, we love it. They rewarded the share price. This latest round, though, these big numbers that came out, and we were warned there'd be big numbers, the stocks would pull back on that news. So that's the equity side. What about the bond side? Are bond sides concerned about the fundamentals here, the bond investors?
Yeah, so what was interesting for me, even on the equity side, is if you thought about this a couple of months ago, numbers like this, alongside the earnings beats that we've seen, was driving a lot of enthusiasm. Now, the same numbers are not, are being seen from a negative lens now. And that's because the investors are now focused a lot more on return on investment, the path to monetization, and rightfully so. Because, this CapEx is accelerating and it's rising from very elevated levels. Now, when you shift to the credit side or the bond side, if you look at, things have been calm as compared to equities. When you look at the tech, so IG tech sector spreads, they're actually flat on the year. Very much in line with what the broader market has done. So the IG tech sector spreads over this year have actually been flat. The big reason for that is these companies, with the exception of Oracle, are sitting on tons of cash, a lot of free cash flow. Yes, I said that free cash flow will be going negative as we move on over the next few years. But the idea is that these companies have a lot of room on their balance sheets before that downgrade happens. And even if that downgrade happens, well, guess what? They will still be in a very high quality bucket. I'll give you an example. So S&P recently affirmed Google's ratings at AA+. They said, well, guess what? Google can come and issue $180 billion in net incremental debt before there's a downgrade concern. For context, Google this year is expected to issue about $30 to $35 billion, which for the most part, it's already done. So technically, it means Google can come 5 more times, given that $180 billion number.
Not get anyone nervous.
Exactly, before that downgrade happens. And guess what? Even if that downgrade happens, you're just going from AA+ to AA mid. for these companies to be downgraded to BBB, again, with the exception of Oracle, Google will have to drive truckloads of debt before that even happens. So very different story than what you have seen within equities. And because of that strong fundamental, the balance sheet, the ratings buffer these guys have, the strong balance sheets they have, IG credit as an asset class can actually withstand a lot more in terms of this, call it the AI disruption or monetization challenges, and be more resilient, and which is why you've seen tech IG sector spreads hold up pretty well.
So those are big numbers in terms of issuance. Just for Google alone, of course, there's several of them that are going to be issuing debt. And some of it's 100-year debt, 100-year bonds. Is there demand out there to meet this issuance?
You've done your homework. So, oh my God, tons of demand, tons of demand. So if anything, the problem is quite the opposite, which is they're coming out with so much supply of bonds, but we as investors are not getting enough. Take Google. So Google came to market and said, hey, I want to raise $15 billion in debt in the US investment grade market. The demand, $100 billion. So they upsized to $20 billion. They took $20 billion in the proceeds from this debt raising cycle. Well, it was easy for them, so it makes sense. Great job, right, from Google's perspective. Now, you pointed to the 100-year bond. So what's really interesting for Google is they actually also went to the sterling market to issue about, call it more than $5 billion in debt. And one of the tranches there for what they issued was a 100-year bond. Very, very, very rare for corporates. It's usually mostly reserved for governments, high-quality governments, and call it long-established universities. For example, Oxford University has a 100-year bond.
What's going to be around in 100 years is the question, right?
So Oxford University has been there since 1300s, and it's structurally important for the country, so it makes sense. But Google, that's a tech company issuing a 100-year bond. So to me, from my perspective, this was sending this is a very bullish signal, if you will, from Google's perspective, because they're issuing at very high interest rates. So they're showing you confidence in their AI journey that they will be able to get this money back. And the demand for that 100-year bond, by the way, was that tranche was greater than 9 times oversubscribed. So pretty impressive there. People can still have concerns around, can these companies still come to the market, and are there funding concerns? We've heard a lot around that. I would tell them to look at Oracle. So Oracle is, as an example, is everything what market was concerned about. High leverage, but leverage still rising up. And then you have, OpenAI concentration, OpenAI, uncertainty around OpenAI being able to pay them in the future, and lots of debt that was at risk of falling into high yield from investment grade. So many bad things. Look what happens. So Oracle comes to market wanting to issue $25 billion in debt. The demand, $130 billion. So really, no demand concerns out there, especially given if you think about these companies, again, outside of Oracle, they have choice whether they want to come and issue in this market because they have lots of cash and free cash flow. So they can say, well, the market is not behaving well. I'm going to step back. I don't need to issue. So that optionality really helps. And to me, there are 3 things that are really supporting that demand. So the first one is, if you could bring up the chart now, the first one is if you look at the tech investment grade sector spreads, look at that arrow. It's already jumped up. And for clarity, spreads are the extra compensation you earn when you buy a corporate bond over a government bond. So that compensation has risen, as you can see. So it's already adjusted for the supply expectation, if you will. The second reason is we as investors, this has been very well publicized and written about. So we as investors were positioned for the supply. The third is balance sheet. As we discussed, the fundamentals are in pretty good shape. And where they are not, which is in the case of Oracle, we as investors are getting well compensated for it. So yes, the demand story is quite supportive from an investment grade lens.
Now, if you go back to the pullback we saw on some of the equity side of the hyperscalers on these plans, I mean, there's 2-3% on any given day. the sharper sell-off has been in the software stocks because of all the fear that AI is going to come in and just disrupt their businesses to the point where people will use the AI and not them. So a lot of risk, fear there on the equity side. Is any of that showing up in the broader credit market?
Yeah, so what's been fascinating for me, Greg, is that when you look at the equity market, it's not just the disruptors, so guys who are actually building or helping build the AI infrastructure, but also the disruptees, which are the software services companies, which will be at risk if this build-up is successful. The stocks were getting hit at the same time. So that was very fascinating for me. Now, when you look at this from a credit lens, there are real concerns. But those concerns, from a credit standpoint, are not evenly distributed. What I mean by that is that pressure is really concentrated within low-quality, smaller companies that have very high leverage. Why? Because high leverage, they need to pay debt. You have these companies that are being challenged, their business models are being challenged, their stock valuations are falling. If stock valuations are falling, that means their underlying asset values are falling. And in that case, your credit metrics are weakening a lot more and very quickly. So this could actually take these companies towards default as well. So it's very important to be careful of those pockets. Now, those pockets are actually concentrated within leverage loan and private credit. But they're lower quality pockets in those, call it, asset classes. About 15 to 20% exposure within leverage loans and private credit to these smaller companies that are highly leveraged. In high yield, that exposure is less than 5%. What's important to watch here, in my view, is the refinancing activity. So there's refinancing wall coming in 2028, which is a big wall. How and when they tackle those will be important to watch, especially with all of what's been going on. But one of the things that I think about right now is the lower you go in quality, the more dispersion there is within fundamentals and valuation. So it's extremely, extremely important to be selective. For example, if you look at high yield, on this, it has less than 5% exposure. So it is pretty insulated relative to, call it, leverage loans and private credit. High yield, on the surface, has not really widened much for the year. But when you look at high yield tech sector, which is where some of these smaller software companies are concentrated, high yield sector spreads or high yield tech sector spreads have widened by 100 basis points. So selectivity really matters. You can't just close your eyes and buy the index. It is a stock picker's market. It is a bond picker's market. And having, call it, experienced managers manage it for you, that have the resources, big teams that are looking through financials, cash flows, covenants, coverage is extremely important. Now, when you look at investment grade, let's shift to investment grade a little bit here. The problem credits are far and fewer because we don't have small companies within investment grade. Most of the exposure within investment grade comes indirectly through BDC exposure. But that BDC exposure is less than 1% of the IG market. So quite insulated on that front. So when I think about the high yield, the broader credit space, to me, investment grade really provides that resilience and has a strong role to play in portfolios today because I can earn that steady, relatively steady income without all the worry that's going on in the market because of all the solid fundamentals that we discussed.